of Management Studies IGNOU presents an audiobook on the course Mmpc 014 Financial Management for MBA program. Presenting Block 3 Financial Decisions, Unit 8 Financial Markets Part 2. Foreign exchange market. The foreign exchange market in India is regulated by Reserve Bank of India, that is RBI. Guidelines have been established for trading in foreign exchange. Limits have been clearly specified by the RBI for investments abroad and the policy for purchase of foreign exchange when an individual is traveling to a foreign country or for any other purpose. Exposure to derivative transactions for foreign currency as the underlying asset can be on currency future exchanges and provides an avenue to hedge risk generated by currency movements. Banks in turn need to hedge their exposures on a back-to-back basis with counterparties in India or abroad, especially for non-USD INR derivatives transactions. Other markets. It has been analyzed in the preceding few sections of this unit the specific characteristics of money markets, capital markets comprising of debt and equity markets, currency markets, commodity markets, and the derivatives markets. In this section, we shall discuss the classification of markets from the perspective of investment and business activities. Loan markets. Loan market refers to the activities of banks and financial institutions to make available credit for corporate sector. The credit may be extended for trading, manufacturing, infrastructure, service, industrial manufacturing, and financial activity or otherwise. Loans may be for short-term or long-term. Usually, credit rating agencies assess the credit worthiness of the corporate. The specific credit rating is used for making decisions by banks and financial institutions to lend to the borrower. Insurance markets. After the liberalization of the Indian economy and the commencement of financial sector reforms, private sector was allowed to start life insurance and general insurance activities. With a growing population, insurance is required by everybody. But insurance companies are allowed to operate by adhering to strict compliance measures due to the high level of risk involved. Retirement savings markets. Retirement savings markets are long-term funds pooled from investors by provident funds, pension funds, and superannuation funds. They perform the important activity of providing resources and security for individuals in their old age. These funds are invested in long-term securities. Mutual funds. Mutual funds provide the means for the small investors to reduce transaction cost while trading in the securities markets. Professional mutual funds have analysts who take calls on the market for collectively investing the corpus of the funds provided by the investors. Mutual funds are regulated by the Association of Mutual Funds in India, that is AMFI, which is a self-regulatory organization. Savings and investment markets. The savings and investment markets consist of several retail financial savings products for the household sector, whereas the corporate sector relies on banks and financial institutions for credit. The household sector is dependent on not only banks and financial institutions that provide retail products, but also on chit funds, nidhis, and mutual benefit societies. Participants in financial markets. The different participants acting as intermediaries for facilitating the flow of funds from surplus units to deficit units in the financial markets are: Number 1. Participants in money markets. Money market is the place or mechanism where short-term funds are raised. These funds are obtained at the varying rates depending upon the sources of funds, the credit standing of the borrowers, maturity period, etc. The main players in this market are the Reserve Bank of India or RBI, Discount and Finance House of India, mutual funds, banks, corporate investors, non-banking finance companies, that is NBFCs, state governments, provident funds, primary dealers, Securities Trading Corporation of India, that is STCI, public sector undertakings, that is PSUs, and non-resident Indians, that is NRIs. Now let's discuss these participants in detail. Central Bank. The central bank of any country is the apex monetary institution in the money market. The Reserve Bank of India is the central bank of our country which regulates and makes policy relating to monetary management in the country. It serves as the government bank because it performs the major financial operations of the government. It is one of the major participants in the money market as it participates in a big way in the market to purchase and sell various securities, specifically those issued by the government. The central bank participates in financial markets in different ways, which are: Number 1. By issuing of currency notes which are directly and solely under the purview of the central bank. For example, in our country, Reserve Bank of India or RBI has been given the sole authority to issue various currency notes except 1 rupee notes and coins and subsidiary coins. For this purpose, the RBI maintains a separate department known as the Issue Department. Number 2. By working as the agent and advisor to the government specifically concerning to the financial matters such as loans, advances, servicing of debts, etc. It also performs such functions of the government departments, boards, and public undertakings. It also decides to meet the financial requirements, both short-term as well as long-term, in anticipation of the collection of taxes or raising funds from the public. Number 3. By acting as banker's bank in the financial market, the central bank regulates the banking operations in the country. How much rate of interest would be charged and paid on advances and deposits by the bankers is influenced by the central bank through various policy measures. Undoubtedly, the central bank holds a privileged position and all the commercial banks have to deposit a pre-decided fixed percentage of their deposits with it. And number 4, by maintaining adequate foreign exchange reserve for meeting the requirements of foreign trade and servicing of foreign debts. It also ensures the stability of the currency at international level. For these purposes, the central bank has to participate in a big way in domestic as well as in foreign financial markets. Thus, it is evident that central bank of the country plays a significant role in money market by participating in different capacities. Next is commercial banks. The other significant participant in the money market of a country is commercial banks. A major portion of the total operations of the money markets are conducted through the commercial banks. The basic functions of commercial banks are borrowing and lending of money. They borrow money by accepting all kinds of deposits from the public at large, repayable on demand or otherwise. Thus, these banks employ the pooled funds in the form of loans and advances to those who need them. The different ways in which the commercial banks participate in the money market are: Number 1. By assisting in mobilizing the public savings, which are normally in the form of small holdings, and then combining the same into a huge lot for the purpose of providing credit to the various sectors of the economy. Number 2. By meeting the short-term working capital needs of the business firms through the mechanism of cash credit, discounting bills, hundies, promissory notes, overdraft facility, and other short-term debt instruments. Number 3. Apart from accepting deposits and granting loans and advances, the commercial banks also provide a range of other services in the capacity of agent for their clients. Number 4. By collecting the amounts arisen due to interest, dividend, rent, salary and wages, commission for their customers. And number 5. These banks also sometimes advise their clients relating to sale and purchase of various securities and in designing their investment portfolio. The next category is indigenous financial agencies. Indigenous financial agencies are important participants in money market, especially in unorganized sector. They comprise of many lenders, that is village sahukars and indigenous bankers. Money lenders are normally referred to those persons whose main business is to provide financial assistance to rural farmers, artisans and others. On the other hand, indigenous banker is referred to an individual or private firm receiving deposits and dealing in hundies or lending money. However, it is very difficult to draw a line between money lenders and indigenous bankers. Some of the features of indigenous financial agencies are: Number 1. They finance trade including the movement of agricultural commodities such as cotton, oilseeds, sugar and others. Number 2. The main technique of their financing is discounting of hundies and bills. Number 3. They also lend money by mortgaging immovable property like houses, land, fixed assets, etc. Number 4. The rate of interest charged by them is normally high in comparison to the banks. Number 5. Their lending policy is flexible and informal, which is based on their personal contacts with the clients, which is not uniform and vary from place to place. And number 6. The loans are provided mostly on personal security, so the size of loan and the rate of interest to be charged also differ from client to client. In brief, indigenous financial agencies provide financial assistance, usually short-term, to rural and semi-urban borrowers at different rates of interest depending upon the personal capability and risk involved. Then comes discount houses. Discount houses are important constituents of the money market. The major function of these houses is to discount trade bills of traders to provide adequate liquidity in the market. Discount houses play a significant role in business world, specifically in money market, such as: Number 1. Assisting the market by making it more liquid by discounting the trade bills. Further, by endorsing these bills, they sell these bills to commercial banks to raise funds so that they can facilitate this service further to the traders. Number 2. Providing guarantee to the bankers for payment of bills on maturity by the traders. In case of default, they take the responsibility of payment. In this way, discount houses provide very flexible instrument whereby the bankers can adjust their cash positions through these houses. Number 3. Besides discounting the trade bills, they also deal in short-term government securities. From the past practice of the discount houses of London, it is observed that these houses also invest in treasury bills, commercial bills, other government securities, bonds and certificates issued by the local authorities and public corporations. Thus, the discount house is an important constituent of a developed money market. This facility is normally provided by the commercial banks and other financial institutions in our country. Number 5. Acceptance houses. Another important participant in the money market is acceptance house. They play a significant role in providing more liquidity in the money market through borrowing short-term loans from the banks and lending the same to the traders. These are not only accepting the bills which are drawn on them, but also perform some other functions like normal banking facilities, both domestic and foreign, short-term loans to the traders, regulating their clients' open credit, advising on shipping and insurance problems arising out of the financing of trade, etc. Acceptance houses provide adequate liquidity in the secondary market through accepting the bills so that these bills can easily be discounted by the discount houses and other banks. However, the existence of these houses is very rare and is seen only in developed money market like London money market. In India, the market is still in its infancy stage of such participants. Participants in capital markets. In this section, financial institutions and other agencies which are actively participating in or facilitating the capital market are described. These institutions can be classified into two categories. Number 1, banking institutions, and number 2, non-banking financial institutions. Some of these institutions may be directly participating in the capital markets, while others may be indirectly connected by way of providing intermediation services to the companies, investors, stockbrokers, and others. Banking institutions. The various forms of banking institutions are commercial banks, cooperative banks, land development banks, foreign banks, regional rural banks, etc. Commercial banks. The important activities of the commercial banks are: number 1. The commercial banks accept long-term deposits from the public at large, providing them opportunity to invest their savings. Further, now these commercial banks also meet long-term funds requirements of all types of business undertakings like tiny, small, medium and large units. Number 2. They also provide long-term finance to transport operators for buying the vehicles, dealers in various goods, farmers, professionals and self-employed persons, etc. Number 3. Banks also provide long-term finance for special purposes like advances against fixed deposits receipts, advances against gold ornaments, advances for durable goods like vehicles, televisions, refrigerators, washing machines, furniture, etc. And number 4, they also assist for construction of houses, purchase of plots and expansion or renovation of the existing building. Cooperative banks. Another important constituent of banking system which facilitates the general economic activities is cooperative banks. The basic function of these banks is to provide financial assistance to agriculturalists and others, normally through cooperative societies. In fact, these banks normally focus on providing short and medium-term financial requirements to agriculturists, artisans and others. Land development banks meet long-term and medium-term funds requirement of agriculturists to purchase agricultural machinery and implements, affecting permanent improvement in land, liquidating old debts, etc. Non-banking financial institutions. Apart from some banking concerns described so far, a lot of economic activities are performed by the other financial institutions which are of non-banking nature. They actively participate in capital transformation process from sellers to investors in an economy. They collect funds by accepting deposits from individuals and others and lend them to trade, industries, government, etc. The various forms of non-banking financial institutions and their role in financial markets are: Number 1. Investment banks. Investment banks are very much popular in developed countries, specifically in USA. Investment banking institution may be defined as financial intermediary which is responsible for garnering the savings of thrifty people and directing these funds into the business enterprise. The basic functions of these investment banks are: Number 1. Long-term financing of business undertakings. It is concerned with the formation of new capital related with the participation information of new capital for both new as well as old undertakings. Number 2. Marketing of shares and debentures. It includes all such activities like originating, underwriting, purchase and sale of securities, etc. Number 3. Acting as security middlemen. It comprises of working as broker or dealer, offering security, counseling, advising, security substitutions and other allied services. Number 4. Advising in marketing of an issue. And number 5. Acting as an insurer instead of outright purchase of security, etc. On the whole, these institutions play a significant role by providing the necessary capital for the long-term needs of the business world. That is why these are also known as the entrepreneurs of entrepreneurs. Some of these functions have been taken over by merchant banks in India. Merchant banks. Merchant banking activities are first developed in early 19th centuries in the UK when trade between countries was financed by bills of exchange drawn on the principal merchant houses. Lately, it has attracted the attention of all financial and consultancy firms. Basically, merchant banking activity is an institutional arrangement providing financial advisory and intermediary services to the corporate sector. In fact, there is a wide range of financial activities which come under the purview of merchant banking. A few among these are: Number 1. Corporate counseling. The major function of a merchant banker is to advise the corporate sector units on various matters like in locating area or activities of growth and diversification, appraising product lines and future trends, rejuvenating old company and failing sick units by appraising their technology, processes, etc. Number 2. Project counseling. Project counseling is another important merchant banking activity which includes preparation of economic, technical, financial and feasibility reports. Further, it also covers project viability and procedural steps for its implementation. Besides these, project counseling may include identification of potential investment avenues and pattern of financing. Number 3. Capital restructuring. The basic objective of capital restructuring is to advise the management of the company in designing its capital structure in such a way that it could achieve maximum potential out of its financial resources. This may include redesign of debt-equity ratio, reserve and surplus, capitalization of reserve, asset structure ratio, debt servicing, with overall impact on funds generating capacity of the corporate unit. Number 4. Issue management. The basic objective of issue management activity is to make all arrangements for mobilizing resources from the capital market for its client by issuing securities like equity shares, preference shares, debentures, etc. This includes taking consent or approval of the government agencies, drafting of prospectus, selection of brokers, underwriters, bankers, registrar, advertising agency, etc. Number 5. Portfolio management. Merchant bankers render expert advice on matters pertaining to portfolio management of their clients. They advise which securities should be purchased or sold and assist in designing optimum portfolio within the purview of risk, return and tax bracket of the investors. Number 6. Credit syndication. The merchant bankers make arrangement of credit procurement and project finance for their client units. In this regard, they contact with banks and other financial institutions both in India and abroad for raising rupee and foreign currency loans. Sometimes they also arrange bridge finance and other funds for cost escalations or cost overruns. Number 7. Corporate restructuring. External restructuring for the overall better performance of corporate units is another important service rendered by the merchant banks. The merchant banks assist in such negotiation and also guide in legal documentations, official approval, tax matters, etc. of the proposed merged unit. Number 8. Working capital finance. The merchant banks assist in arranging working capital finance for their clients. They advise the possible sources from where the working capital finance can be arranged. Further, sometimes they also manage to enhance cash credit facilities for their clients. And number 9. Credit bills discounting. This is one of the major services which is rendered by the merchant banks, especially in developed countries like USA, UK, etc. They make arrangements for providing bills discounting facilities for their clients after contacting the acceptance houses and discount houses. Then comes investment companies. Investment companies are such institutions which collect the funds from the people through a specific financial instrument, that is, unit, share, debenture, etc., and then invest these pooled funds in the suitable securities depending upon the objective of that scheme. The major investment type companies include investment trusts, mutual funds, common trust funds of commercial banks, management investment companies, unit trusts, etc. These investment companies can be classified into two categories. Number 1, management investment companies, and number 2, unit trusts. Management investment companies. The managements of these trusts enjoy wide discretionary powers relating to selection of various securities for designing of their investment portfolio. The schemes of these companies can further be divided into two categories, close-ended and open-ended. In the first category, the capitalization of the scheme is fixed and not changed before a particular period. In other words, unit holders cannot get back their investment from these companies before a particular period. Whereas in the case of open-ended companies, the investors can sell and buy their units from the company and hence no limit to capitalization. Number 2, unit trust. This is a specific type of investment company which is normally established under a particular act. The funds are raised from the large number of investors through selling of the units, and the persons to whom the units are sold are called the unit holders. The holders of these units are the owners of the trust who have a real interest in securities which constitute the trust fund. Normally, a unit trust is established as an open-end investment company. Unit Trust of India is an example of the same. Thus, the investment companies are important participants in the capital markets. They mobilize funds from many investors and channelize the same for productive purpose through financial markets. Number 4. Insurance companies. Insurance companies have emerged as prominent participants in the capital markets because of the availability of huge funds at their disposal for investment purpose. These companies can be classified into various categories such as life insurance companies, general insurance companies, marine insurance companies, which cover risk arising from fire, accidents, natural calamities for human lives, vehicles, houses, durable goods, fixed assets, etc. Among these, life insurance companies are dominant due to their large size and protection from state. The major source of funds of these companies is premium received from the policyholders. Being the custodians of policyholders' savings, the responsibility of these companies to the public is very high. Hence, the investment policy is usually different from that of other institutions. The major portion of the fund is normally invested in government and semi-government securities, fixed income securities of public sector units, and other corporate sector units. Apart from life insurance companies, general companies which are in insurance business of fire, marine, and others also have huge investable funds to employ in the business sector. In brief, insurance companies recently have become an important constituent of capital markets all over the world. Number 5. Development banks. Development banks, which came into existence after the Second World War, are now most active participant in the capital markets all over the world. In India, some major development banks are Industrial Finance Corporation of India, that is IFCI, State Financial Corporations, that is SFCs, State Industrial Development Corporations, that is SIDCs, Industrial Reconstruction Bank of India, that is IRBI, IDBI and ICICI, which were originally started as developmental banks, got converted themselves into universal banks to face the challenges in the liberalized environment. Number 6. Pension funds. Pension funds and retirement plans of all types have become important investors and participants in the capital market. In developed countries, private pension plans or corporate pension funds have become major constituent of the capital market largely in the second half of the 20th century. In a pension plan, pension holders are provided with a fixed amount in particular currency each month, often calculated as a multiple of the number of years worked in that organization. It has been observed that assets in pension funds grow over long period because most of the employees who come under a plan are several years from retirement. Number 7. Private sector finance companies. These companies collect funds from the people through shares, debentures, fixed deposits and short-term loans from banks and other corporate units. Sometimes a huge fund is also raised through intercorporate deposits. Besides, they also provide short-term business credit to the business firms and professionals. Thus, these finance companies have to compete with commercial banks and other financial institutions which provide such loans. Thus, these finance companies play a significant role in capital market, fulfilling financial needs of specific section of the society. Further, they borrow in both money market and capital market, so they create a link between these markets and relationship between long-term and short-term interest rates. Now let's summarize the unit. A market is a place where buyers and sellers meet to exchange goods, services, or even financial products or instruments for a consideration. Markets can also be defined as channels through which buyers and sellers exchange goods, services, and resources. The present-day markets gradually evolved over several centuries. In this unit, we have discussed in detail about the financial markets. Financial markets facilitate trading in financial assets. Since financial assets are not consumed, what is bought and sold is their use for a particular period. There are many agencies which are participating in the financial market operations and are facilitating the process of transfer of funds from surplus units to deficit units. These participants of the financial markets that facilitate the smooth flow of funds from surplus units to deficit units in both the money markets and capital markets have been elaborately discussed. The capital markets involve raising finance through issue of publicly traded financial instruments in equity and debt that can be bought and sold at any time. For facilitating this framework, financial intermediaries play a very important role. The capital markets include money markets, debt markets, and equity markets, savings and loan markets, retirement or pension fund market. Other markets include commodity and currency markets and more sophisticated markets such as the derivative markets. The characteristics of currency and commodity markets, derivative markets, including the concept of OTC and exchange traded derivative markets, has also been discussed. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code Mmpc 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.